It took only a single weekend to bring down a 158-year-old institution. On Monday morning, September 15th, 2008, the world woke up to something that seemed impossible. Lehman Brothers was gone. The fourth largest investment bank in the United States had declared bankruptcy, the biggest in American history, with more than $600 billion in assets and $619 billion in debt. Within hours, markets everywhere went into shock. The Dow Jones plunged 500 points. Credit froze across the globe. What had started as a housing downturn quickly turned into a near-death experience for the global economy. But here's the truth. Lehman's fall wasn't some mysterious black swan. It wasn't random, and it wasn't unexpected. It was the unavoidable collapse of a system built on greed, a system where profits were private, risks were public, and reality didn't have to matter. Every empire falls the same way, slowly and then suddenly. And this one began crumbling long before 2008. Lehman Brothers was founded in 1850 in Montgomery, Alabama, by three German Jewish immigrants. Brothers named Henry, Emmanuel, and Mayer. They started out as cotton traders, lending money to farmers and connecting the American South to the booming textile mills of Europe. Over time, their business evolved from selling goods to financing them, then to underwriting railroads, factories, and eventually the great machinery of Wall Street capitalism itself. By the early 1900s, Lehman had survived the Civil War, 2 World Wars, and the Great Depression. It had financed industries that shaped modern America from steel and oil to retail and airlines. During the post-war boom, it became one of Wall Street's most trusted names. Conservative, quiet, and family-run. It was a firm built on reputation and caution. But by the 1980s, the financial world had changed, and Lehman changed with it. The Reagan years brought a new ideology, deregulation, the Glass-Steagall Act, which had kept traditional banking separate from risky speculation since the 1930s, was being taken apart piece by piece. Debt was no longer something to fear, it was an instrument. Leverage became a philosophy. Borrow cheap, buy big, and ride the rise for as long as you could. In this new landscape, Lehman reinvented itself not as a banker, but as a player. It began betting on real estate, bonds, derivatives, and anything else that could be packaged, priced, and sold for profit. Wall Street wasn't funding industries that made things anymore. It was engineering financial products that made money from money. By the early 2000s, this thinking had reached its peak, the invention of mortgage-backed securities. The idea seemed brilliant: bundle thousands of home loans into a single product, sell slices of it to investors, and spread out the risk. It was the financial version of alchemy, turning debt into gold, except the gold wasn't real. Banks started handing out mortgages to anyone who could sign a piece of paper, no job, no income, no proof required. The loans were shaky, but it didn't matter. They were bundled together, stamped with AAA ratings, and sold to pension funds and insurance companies as safe assets. It was innovation in name only, a pyramid scheme disguised as progress, and Lehman Brothers was one of its proudest architects. By 2007, Lehman had become a real estate powerhouse, holding more than $600 billion in assets, but only $22 billion in real equity. That meant a leverage ratio of nearly 30 to 1. For every dollar the firm actually had, it borrowed 30 more. That wasn't investment. It was financial Russian roulette. Yet the markets didn't care. The stock price kept climbing. Bonuses flowed like water. The illusion of wealth grew stronger. Wall Street wasn't measuring risk anymore, it was selling it. And at the top of Lehman Brothers was a man who embodied that era's pride, Richard Dick Fuld. Cold, combative, and obsessively loyal to the Lehman name, Fuld believed in domination, not diplomacy. Under his leadership, the company's appetite for risk exploded, and so did his own paycheck. Between 2000 and 2008, he made around $480 million, while the foundation beneath him rotted. When analysts warned that the housing bubble was bursting, Fuld dismissed them. When Bear Stearns went under earlier that same year, he insisted Lehman was stronger. When investors began to panic, he blamed rumors and short sellers. But numbers don't bend to confidence. The housing market was imploding. Mortgage securities were losing value, and Lehman's debt now outweighed its assets. Billions vanished from the books by the hour. By September 2008, The U.S. government had already stepped in to rescue Bear Stearns, with help from J.P. Morgan Chase. It had also moved to save Fannie Mae and Freddie Mac, the two giants of America's mortgage system. Lehman expected the same deal, a bailout or a buyer, but this time Washington refused. Treasury Secretary Henry Paulson, a former Goldman Sachs CEO, announced that the era of rescues was over. No more bailouts, he told Congress. His reasoning was simple. Saving every reckless firm created moral hazard. If you never let the guilty fail, they'll never stop gambling. So on Friday, September 12, 2008, government officials and bankers gathered at the New York Federal Reserve to look for a way out. Barclays seemed interested in buying Lehman, but British regulators refused to back the massive losses. No other bank stepped up. By Sunday night, the verdict was final. Lehman Brothers would be allowed to fail. Paulson and Federal Reserve Chairman Ben Bernanke believed the system could take the hit. They were wrong, disastrously wrong. At 1:45 a.m. on September 15th, Lehman Brothers filed for bankruptcy, and the financial world collapsed in real time. Within hours, global credit markets froze. The system that kept money flowing between banks locked up completely. Institutions stopped trusting one another's balance sheets. They didn't know who would fall next. Trillions in short-term loans disappeared. Even stable companies suddenly couldn't refinance their debt. The panic wasn't limited to Wall Street. It spread across oceans in minutes. In London, trading floors emptied. In Tokyo, credit default swaps surged. In Frankfurt, banks scrambled to cover their US exposure. Within a week, the biggest economies in the world were all staring at the same screens, watching red numbers plunge lower. To understand how massive the failure was, you have to see how fragile things already were. Lehman wasn't a free case, it was the blueprint. Every major investment bank was doing the same thing, borrowing short-term money to buy long-term, illiquid assets. When housing prices rose, it looked like magic. When they fell, that same leverage turned profits into explosives. Lehman's leverage stood at 30-1, but Merrill Lynch's was 27-1, and Morgan Stanley's was 32-1. The whole structure was made of borrowed glass, and Lehman was just the first pane to crack. When it fell, the illusion of safety vanished with it. Investors fled to cash. Money market funds, once considered as safe as savings accounts, started breaking the $1 peg that terrified ordinary people. If even safe money wasn't safe, what was? Governments tried to project calm, but behind the scenes, panic ruled. The Federal Reserve began injecting hundreds of billions in emergency funds, buying up assets that nobody wanted. And that's when the hypocrisy showed itself. Because after letting Lehman go under, the government saved everyone else. Aid got $182 billion. Goldman Sachs and Morgan Stanley were instantly converted into bank holding companies, giving them access to Federal Reserve emergency lending. Citigroup and Bank of America received billions in taxpayer money. In the same week that Lehman employees lost their life savings, Wall Street's biggest firms were handed blank checks. It wasn't about principle. It was about power. Lehman didn't have the right allies. Goldman Sachs did. That choice to let one firm die and rescue the rest turned a financial crisis into a catastrophe. Trillions in market value disappeared. Millions of people lost their jobs. Over 10 million Americans lost their homes. The global economy shrank by the size of Japan, and yet the people who caused it all walked away richer. Dick Fuld earned nearly $500 million during his years at Lehman. After the bankruptcy, he appeared before Congress, blamed rumors and short sellers, and walked free. No charges, no prison, no justice. That's when people began to understand something unsettling. In modern capitalism, failure isn't punished, it's protected. The government launched the TARP program, a $700 billion bailout, to buy toxic assets and recapitalize banks. The Federal Reserve quietly funneled more than $16 trillion in emergency loans into the financial system, including to foreign banks. It was the largest wealth transfer in modern history. Packaged as economic stability, Wall Street called it saving the system. But what they really saved was themselves. That was how the post-Lehman world began, a world where markets no longer reflected the economy but replaced it. After 2008, central banks became the economy's life support. Interest rates dropped to zero. Quantitative easing flooded the world. with cheap money. It didn't reach workers or small businesses. It poured into asset stocks, bonds, real estate, commodities, all inflated by artificial liquidity. The result was the biggest fake recovery in history. The stock market doubled while wages stayed flat. Billionaires doubled their wealth while families sank deeper into debt. Inequality exploded. Lehman Brothers was supposed to be the warning. Instead, it became the blueprint. Once the government proved it would save the system at any cost, risk stopped meaning anything. Investors stopped asking, "What if this fails?" and started asking, "How big will the bailout be?" Every bubble since has followed the same pattern. The tech bubble burst and the Fed cut rates. The housing bubble burst and the Fed printed money. The pandemic hit and central banks created trillions overnight. Markets didn't just recover, they learned that reality was optional. But cheap money comes with a cost: addiction. The global economy now depends on debt the way a patient depends on painkillers. Each dose soothes the symptoms but weakens the body. By 2020, global debt had passed $280 trillion, triple the world's yearly output, and the same ingredients. That caused 2008 leverage, speculation, blind faith. We're everywhere again, only bigger. Crypto promised freedom from banks and delivered chaos. Meme stocks turned trading into gambling. Tech valuations climbed to absurd heights, disconnected from any real profit. Real estate soared again, fueled by record low rates, and every time the system trembled, the same fix was prescribed: print, borrow, inflate, repeat. Here's the truth. Every rescue digs the next hole. Every bailout plants the next bubble. The illusion of control has replaced real stability. The financial system learned how to survive collapse, but only by spreading the pain to everyone else. Banks can fail. Nations can default, but the machine keeps running. That's the hidden legacy of Lehman Brothers. The normalization of failure itself. We call it capitalism, but it isn't. It's risk socialism, profits for the few, losses for everyone else. And that model shapes more than economies. It shapes politics. Once money becomes infinite for the powerful, democracy becomes negotiable. The system bends toward whoever can outlast the crash. That's why Lehman still matters, not as a company, but as a mirror. It showed what happens when debt becomes destiny. When wealth is measured not by what you create, but by how much you can borrow. 15 years later, we live in a world built to avoid another Lehman. Not by fixing what broke, but by making sure nothing is allowed to break at all. The financial system is now so vast and intertwined that it can't be repaired without collapsing. So central banks play God. They print, they pause, they raise, they rescue. And the rest of us hold our breath. But here's the truth. Every illusion of safety has an expiration date. The next collapse won't look like 2008. It won't start with a bank run. It will begin with a confidence run. When people stop believing the system is under control, because at its core, money is trust. And once trust breaks, there's no bailout big enough to restore it. Lehman's fall wasn't just the end of one firm. It was the moment the mask came off. We saw how fragile the free market really is, how democracy bows when finance panics, how power never wastes a crisis but remakes it. And what did we learn? That in modern finance, every rescue plants the seed of the next crash. Every fix writes the next failure. The 2008 collapse was the moment we crossed the line, from capitalism to simulation. Now markets don't measure reality, they manufacture it. That's why understanding Lehman isn't nostalgia, it's survival, because everything that came after was built on its ruins. The illusion of control, the dependence on credit, and the quiet assumption that someone else will clean up the wreckage. And that illusion, not bad loans, not weak rules, not one arrogant CEO, is the real bubble that still hasn't burst. Lehman Brothers didn't just fall. It exposed how the system truly works and who it really works for. If this changed how you see it, hit subscribe. History has the answers. I'll show you where to find them.